Today, we're reviewing 0xBlock Finance, a project that offers 500% APR in 0xBlock tokens and which has really interesting characteristics as well as a very transparent team. Let's get into it. First of all, let's start explaining what is 0xBlock. 0xBlock aims to become the largest, most transparent hedge fund in the DeFi space and deliver an enjoyable, profitable experience to investors of all kinds. The project launched about 1 month ago in the Avalanche network, and the goal is to provide solutions for investors that want to get the returns of the DeFi space without having to deal with the risks of the DeFi space. They have been KYC by Azure DeFi, and they are very clear about the actions that the team takes in the project. At the moment, the project works by using the investors' funds to invest in other cryptocurrencies and profitable protocols. However, they are also developing other utilities to sustain the protocol, like a DEX, a Launchpad, and other utilities we will see later in the roadmap. One of the things I like about the project is that they did a fair launch. Basically, they skipped the pre-sales and seed phases and went straight to selling to the public, which makes it more fair for investors and avoid pre-sale investors dumping the price. The initial distribution of the token was 70% in the rewards wallet, 10% in the liquidity wallet, 10% in the development and marketing wallet, and 5% in each of the two founders' wallets. However, the founders' wallets have a 1-year vesting. 0xBlock Finance has 3 different ways of investing into the project, which are contracts: the Square, the Cube, and the Tesseract. Each of them has a different cost in 0xBlock tokens and give different APRs. The Square contract costs 5 tokens and gives 250% APR and has a return on investment of 146 days, meaning that you earn the amount invested in that time frame. On the other hand, the Cube contract costs 15 tokens and gives 400% APR, while having a faster return on investment of 92 days, meaning that you can earn the amount you invested in 92 days. The last contract is the Tesseract contract. It costs 30 tokens and gives 500% APR, having a return on investment of 73 days, the best of the 3 contracts. One special feature worth mentioning is that once these contracts are minted, they are permanent, as the user cannot retract their 5, 15 or 30 tokens spent, but only withdraw the returns that the contract gives. This is similar to other investments like Strongblocks or Drip, in which you cannot withdraw your invested capital, but you can do it so with the returns that capital provides. This feature gives the project a higher risk from the get-go, because you won't be able to withdraw everything if in the future things go sideways. However, keep watching because there are some things this project has that could compensate this commitment, and which we will see afterwards. Now let's get into what the project does with the funds they get from contract minting. 50% go to the rewards wallet to pay the APR. 20% goes to the treasury to invest in other protocols. Another 20% goes to the liquidity pool to provide the 0xB AVAX pair, while the last 10% goes to the development wallet. Up to this point, the project may not seem sustainable, because according to these numbers, they only dedicate 20% of the funds to invest in other protocols to pay back the APR to investors, while a much bigger part, accounting for 50%, goes to the rewards wallet. This made me think that in the initial phases of this project and until they come up with other income sources, the project is highly dependent on people minting contracts to be sustainable. However, the next thing that we will see plays an important role in the sustainability of the project. It is the reward decay model. This model of decaying rewards reduces the interest given by contracts over time, making the project more sustainable. Every 3 months, the rewards are reduced by 15% for a total of 4 times. Taking into account that the timer starts when you mint the contract and not when the project started. So it is not dependent on how old is the project, but how old is your minted contract. This model already makes the project more sustainable because it doesn't promise really high rewards indefinitely. That will either make the project unsustainable or cause a lot of inflation in the token. But even with the rewards decay model, I think that the project will need other income sources to sustain this APR. And that's why we will briefly review the future utilities that the project will bring to increase the income of the project. As we can see in their white paper, they have 3 developments for the future: a decentralized exchange, a launchpad for projects, and a wallet. I think the most important ones are the DEX and the Launchpad, because they are the ones that, if executed successfully, could bring additional income to the project to make it more sustainable. At the end of the day, remember that in DeFi, most projects start by giving a very high interest rate in order to attract investors. It's simply a marketing technique. However, once the project launches, a countdown starts, and the project team should do everything they can to make the project sustainable. If you enjoyed this video, leave a like and subscribe to see more to the point crypto content. Thanks for watching and see you in the next video.